Hi, my name is Pasang Sherpa, and today I'll be analyzing 10 different companies from 2 industries. The industries that I'll be analyzing are fast food restaurants and teen and young adult clothes stores. To examine the past and present financial performance of these companies, we'll be looking at various ratios. That includes short-term solvency, long-term solvency, asset management, profitability, and market value. My first industry is fast food restaurants, and the companies that I've chosen are Panera Bread, Wendy's Co., Domino's Pizza, Cheesecake Factory, and Jack in the Box. The first ratio that we'll be looking at to analyze these companies is return on equity. Return on equity helps us figure out how much the company is generating out of the money invested by the shareholders. We can clearly see here that Panera Bread has the highest ROE of 24.82, followed by Jack in the Box with an ROE of 24.37. Information was not available for Domino's Pizza in Bloomberg, so we have the information for 4 different companies here. The ROE trend over the past 5 years is shown in this graph. Jack in the Box had a very fluctuating ROE over the years. It increased slightly in the year 2011 and decreased in the next 2 years, and right now it has increased significantly as compared to the ROE in fiscal year 2013. Panera Bread has more of a very consistent ROE. It has slightly declined, but compared to the industry, it's still the highest. Since ROE is affected by many different factors, we will be analyzing this using DuPont analysis, which is commonly also known as ROE decomposition. We'll mainly focus on operating margin, total asset turnover, and financial leverage. The profit margin of a company lets us know how much a company has made out of its sales. So it's basically how much a company makes on every dollar of sales. The higher the margin, the better. Domino's Pizza has the highest profit margin here, and followed by Panera Bread, which is at the second most level. It has significantly decreased in 2014 compared to the other in the industry. Wendy's has increased consistently. The profit margin has increased consistently in the past 5 years. Asset turnover is how much successful that the company has been in utilizing assets to increase their revenues, and Domino's Pizza has been the most successful out of these 5 companies. The asset turnover for Panera Bread is very consistent. It has actually increased by a very little in the current year. For the rest of the companies in the industry, it has increased a little bit, as you can see. For Cheesecake Factory, decreased for Jack in the Box. Financial leverage is the next ratio that we'll be comparing these companies over. Since information was not provided for Domino's Pizza, we only have information available for the other 4 companies. Jack in the Box, we see that the financial leverage is fluctuating like it did with the ROE. Since ROE is influenced by all these different factors, we can clearly see that ROEs for Jack in the Box is being driven by the high leverage. That means that they are taking more debt to support their operation and to finance the assets. Panera Bread, which had the highest ROE, actually has the lowest among these 4 lowest financial average. This means that they could actually haven't relied more on debt to support the operations when they could actually be using more leverage to magnify their gains. And as we know, leverage magnifies gains and leverage magnifies losses. Panera Bread can utilize this opportunity and gain more debt in order to increase their profitability as a company. So ROE decomposition with the current year numbers are here. We have Panera Bread and Jack in the Box because these were the 2 with the highest ROE. As you can see, the operating margin is high for Panera Bread. They have been able to generate more profit out of their sales. They also have been very successful in utilizing the assets as compared to Jack in the Box, and they're using lower leverage. And as I said before, they could be utilizing more leverage and generating more profit as compared to Jack in the Box. And we can also see that the Jack in the Box ROE was actually driven up by financial leverage, which would make it not an attractive investment. The next ratio we're covering is interest coverage. It basically tells us the company's ability to pay interest on its debt obligations. Panera Bread has a very high interest coverage ratio of 125.45, which means they are very able to fulfill their obligations. However, Domino's does not have a significantly lower interest coverage ratio at 3.85 and Jack at 11.48. We have the price to earnings ratio graph over the 5-year period for these 5 companies here. Wendy's has a very fluctuating PE ratio, meaning the market now believes that it does not have as much potential for growth as it did in 2013. It's decreasing. For Domino's Pizza, the market believes that there is potential for them to grow financially over the years. And for Panera Bread, it has been a slight decrease, but it hasn't decreased as much, so it still shows that people believe that there's potential for them to keep on having the same profitability, or at least remain consistent over the years. Economic value added is what remained after the cost of capital has been paid off. Domino's Pizza has the highest economic value added, and followed by Panera Bread. Jack in the Box is very fluctuating. It's actually decreased in the current year, which is not a very good sign as far as for investors. So after analyzing all these different ratios, we've come to the decision that Panera Bread is the best in the fast food industry among the 5 companies that we've chosen. It has a low leverage and high profitability, which makes it very attractive to investors. It also has a consistent economic value added, ROA, and asset turnover. And since investors look for consistency, growth, and stability, Panera Bread makes a very attractive investment. The next industry that I'm comparing and analyzing is teen and young adult clothes stores, and the 5 companies that I've chosen are Abercrombie & Fitch, American Eagle, Aeropostale, Urban Outfitters, and the Buckle Incorporation. I'll start with the same process as I did in the prior industry. Looking at our return on equity first, we see that Buckle Incorporation has the highest ROE at 49.90. Aeropostale has the lowest at a negative 41.05, which clearly shows us that investment in Buckle Incorporation seems very attractive at this point, where it's way higher, almost like 50% higher than the industry averages. Over the 5 years, we can see that Buckle has a rising and very consistent ROE. However, for the rest of the industry, it's almost decreasing. Aeropostale's ROE has declined the most in the past 5 years. The profit margin for Buckle Incorporation again is very consistent. They've been able to generate profit from their sales at a very consistent rate. They've been able to manage their cost of variable cost of production. So this is a good feature for them. And for as far as the rest of the industry is concerned, it's decreasing for Aeropostale, American Eagle, and Abercrombie & Fitch. Urban Outfitters, it has increased in the past 2 years, but is not as profitable as Buckle Incorporation. Asset turnover, we can see that Aeropostale has been very successful as far as utilizing the assets to generate revenue is concerned. But since their ROE was negative, we know that there are other factors that are affecting the profitability. Asset turnover for Buckle Corporation is pretty good. They have been, like I said before, they've been very consistent and actually increasing a little bit over the past 2 years. As far as financial leverage is concerned, Aeropostale has been taking the most has been depending the most on debt to finance their operations and assets. So we can see, as we all know, that leverage magnifies gains and leverage magnifies losses. Their high financial leverage could be a reason why they have a negative ROE at this point of time. And as far as Buckle Corporation is concerned, it is still lower than the industry average, meaning it could take more leverage and increase its profitability. So the two highest ROEs, companies with the two highest ROEs were Buckle Corporation and Urban Outfitters. Comparing their profit margin, we can clearly see that Buckle Corporation is way too successful, has almost double the operating margin as compared to that of Urban Outfitters. They've been also successful in utilizing the assets to generate revenue, and they have a very slightly higher financial leverage, which does make sense that at this financial leverage they have been able to generate a lot of profit compared to Urban Outfitters, who's almost like 25 points shy in terms of financial leverage. So the price to earnings ratio for these 5 companies over the 5 year, we can see the trend here that Aeropostale, it has decreased in 2011, it increased slightly in 2012 and 2013, but it has dropped significantly in 2014, meaning it has the most consistent one, as we can see in the graph. All the others are fluctuating in the past 2 years. Economic value added, as far as this is concerned, again we can see that Buckle Corporation has the most consistent EVA. They have been able to keep almost the same amount of residual revenues after deducting their cost of capital, while for other companies it's been decreasing or increased slightly, yet BKE, Buckle Corporation, has the highest EVA. So after the analysis of the teen and young adult clothes store industry, I've come to the decision that the Buckle Corporation is the best in this industry. It has the highest ROA profit margin. It also has a lower leverage compared to the industry average, and it could be utilizing more of it to increase its profit. And it's very consistent over the years, and as investors, consistency is makes a company attractive. So my final comparison is between the best of the two industries. I have Panera Bread and Buckle Corporation, and I'll be analyzing them over the 5 different ratios, which is financial leverage, return on equity, price to earnings ratio, market to book ratio, and economic value added. So the ROE for Buckle Corporation is almost the double of that for Panera Bread, and we know that this is because of their efficiency in utilizing the assets as well as reducing their cost of production. The financial leverage for Panera Bread is higher as compared to BKE, yet their ROE wasn't as high as Buckle Corporation, so this makes Panera Bread more riskier as compared to Buckle. The PE ratio for Panera Bread is high compared to BKE. However, we see here that the price to earnings ratio for Buckle Corporation is more significant, whereas that for Panera Bread is decreasing. And the price to book ratio helps us find if the market believes the stock is underpriced or overpriced. And since we can see Buckle Corporation share PB ratio is lower compared to Panera Bread, the market believes that it is a little underpriced as compared to Panera. And the EVA spread for Panera Bread is higher than BKE. So even though the Panera Bread BKE has a lower EVA than Panera Bread due to the high ROE, profit margin, and asset turnover, and the lower financial leverage. The best company to invest in would be Buckland Corporation. Thank you.